So here's the income statement that we looked at. So again, looking at the bottom line, net profit was minus 48.79. So my point was earlier, if all we look at is the income statement, I see the net loss of 48.79. And if I don't look at a cash flow statement, I know I used to make this mistake. I used to assume that that loss of 48.79 would translate to about a $5,000 cash loss. And yet, as we've now, Natalie, go forward a couple to the cash flow statement. As we look at the cash flow statement, at the bottom of the cash flow statement, we see where it says total cash flows. Our difference in cash for the same month, for the same time period, is not a minus 5,000. It's actually a minus 28,000. And that's what I want you to just keep in mind as you're looking at your income statement versus your cash flow. Big difference between what you see on the income statement and what you see on the cash flow. And again, the difference is the income statement is on an accrual basis. The cash flow statement is on a cash basis. Any additional questions on this?
So the accrual basis, sorry, this is Eleanor again. So the accrual basis is, equipment and whatnot, and we're taking depreciations versus the cash flow is what's in the bank, actually.
Absolutely. And the other distinction, Eleanor, is the income statement. We're in the balance sheet, we're taking into consideration our accounts receivable and our accounts payable. The delay between when we sell something and when we collect it, or the delay between when we incur an expense and we actually have to pay for it. And that's, again, explains the difference between the numbers on the income statement and what we see on the cash flow statement.
And so the cash flow is just the money that we've received, hard payments that we've received in the bank.
Yeah, pure cash. Yeah.
Okay.
Very good.
Thank you.
Yeah, you're welcome.